go ahead and react to some videos.
Have you on a day like today where the major averages are not only lower on the day, they're lower on the week, and the Dow, the S&P, and the Nasdaq are now also lower for the month of February so far. We teased it ahead of this conversation, the fact that you're seeing a contrarian bullish signal here. What is it?
Well, it's a couple things, but I'd say what really stands out to us is that the market has eluded extended periods of weakness because investors are bearish at the highs at a time when there's record cash on the sidelines. So to us, this is a market that is very...
I got to push back against Tom Lee here. I don't know about this whole record cash on the sideline. Maybe from the standpoint of like, he's probably looking at money market funds, but the issue is a lot of that money's not coming off the sideline. And if you look at how invested fund managers are, I believe right now, I looked at some data here recently. From what the data I saw, let me pull up my private group Discord chat. I believe I posted this data here recently. Alrighty guys, here we go. So what I'm showing you right now is fund managers. Okay, fund managers in their average cash level as a percent of assets under management. And what we're going to find right now is it's extremely low. Extremely low. So Tom Lee is correct in that there's a massive amount of cash on the sideline, the whole $7 trillion or whatever, right? But when you look at like what the active managers are, the fund managers, right? They're actually really low in regards to cash levels right now, which means they're heavily invested into this market, right? And what you see time and time again is when this number actually gets high, it's usually a phenomenal time to actually be buying stocks. When it gets to very low levels, I don't want to say it's a bad time to invest, but it's not as opportune, right? But you can look at other time periods where things got low in the past and you still made so much money, it was ridiculous. Like right here, look at how low cash levels got right here in 2011, for instance, right? Guess what? If you're buying stocks in 2011, like I was, you did very well for yourself, okay? Right here, 2013, cash levels got very low. Still a great time to be a buyer of stocks, right? Look at right here. Great time to be a buyer of stocks. Right here, great time to be a buyer of stocks. So that's an important thing to keep in mind here. I think this chart's more important from a standpoint of when it gets really high. When it gets really high, it's basically almost a guarantee of like, this is a crazy buying the dip opportunity and you better be loading up on stocks. But if it gets low, honestly, it's hard to say it's bad or good because we have several time periods in the past where it got low and it was still a great buying opportunity in the market at that particular time. So do keep that in mind. Something else I want to show you guys here is from the weekly investor report, okay, that we put out to the private stock group members. I want to show you guys something very important here. Take a look at this. So this is how bearish or bullish investors are in the market from the AAII investor sentiment, right? And what we're going to find is right now, recently, 2 straight weeks, we have 40% plus of people in the market basically that do this survey are bearish on the market the next 6 months. So I think that's just worth keeping an eye on. Now, that's usually a good sign. I like it. The more people are bearish, the more I actually feel comfortable in the market. Oh, nice highlighter Lambo there. The more bearish people are, the more I actually feel comfortable in the market. So do keep that in mind. The more bullish people are, sometimes I get a little more concerned.
Skeptical of these new highs, that bearishness and concerns about tariffs means there's a wall of worry. So I think this is actually a very positive setup for stocks.
So you're not concerned about some of the data we've gotten? I mean, that University of Michigan consumer sentiment reading this morning in particular seems to have spooked investors, given the fact that it cited broad declines across age, income, wealth groups. You also said that big spike in year-ahead inflation expectations. That was unchanged, but the 5-year expectations moved.
Also, take a look at this here. Check this out. CNN Fear and Greed Index, 35 this week. So we're not in extreme fear right now, but the market is certainly in fear mode based upon the CNN Fear and Greed Index. And then she was mentioning about which survey was she talking about there? Oh, consumer sentiment, right? University of Michigan consumer sentiment. We have that data here too. University of Michigan's consumer sentiment survey reads 64.7 in February, down from January. Oh, that sucks. I mean, guys, a good consumer sentiment number is around 100, okay? Somewhere between 90 and 100. These numbers suck. I don't know other way to sugarcoat it. It's just they're bad, like very bad consumer sentiment still out there at this point in time. And that's not new. Like consumer sentiment has been in a tough place for years now, man. It's been like that for years. So hopefully at some point in time we break out of that. But geez, man, consumer sentiment has been brutal.
Or two. At what point does that start to manifest into something more meaningful in terms of a slowdown here in growth?
Well, these inflation expectation surveys matter to the Fed because they are concerned about whether or not consumers are actually raising their inflation expectations, and that would in fact be bad. But we have to keep in mind the UMich surveys do seem to be polluted by political affiliation. When you break down respondents by Democratic responses, they've gone from seeing inflation under 2% before the election to over 5% today. Republican respondents have gone from 4% to basically zero. In fact, if you look at the distribution of responses for those Democratic respondents, almost 7% think...
Oh, it makes me want to throw up. And this is why I hate freaking politics so much. This is why I hate politics and I hate the whole system so much. This is why I don't even get involved with it. It makes me want to throw up. Oh, gosh. It's so typical. It's like, that's just the way it is. Like Democrats, the Republicans in office, everything's bad now, right? But everything was good before. And then the Republicans, the Democrats in office, everything's bad. Oh, the Republicans in office, everything's good now. Oh, my gosh, it's all blue sky. It's so, oh, gosh. Oh, this is why I can't even get involved with that. It's so low IQ. Oh, man, I despise it. I really despise it. Oh.
Is currently at 25%. So I think that there is a lot of pollution in that data, and I think it's probably pretty typical what happens when there is a change in administration, but I hope the Fed is aware of that political dynamic.
So, Tom, if I recall, in Q4...
It's not political dynamic, it's political stupidity.
Year, you were warning about market turbulence, and we've been right now at around S&P 6,000. We're at the level where we were a month ago, a month before that, in late November. Should we also expect turbulence at these levels at this point, given that the macro narrative and the political landscape is still unclear?
It certainly seems like it. I mean, I think investors can cite a lot of things top of mind why short term they're expecting the turbulence. We're coming off two back-to-back 20% years. We know there's significant uncertainty about tariffs. In our latest client survey, 63% of our clients, and that's over almost 2,000 respondents, said tariffs or deportations is the biggest risk. That's up from 54% last month. But these are not things that have necessarily long-term negative effects. In fact, things like the number of Fed cuts is actually back towards 2. And I think there's a possibility the Fed may actually make cuts sooner. I think one thing the market is being complacent on is thinking the Fed's on hold. But if this turbulence causes hiring to slow, I actually think the Fed could actually be making cuts a lot sooner, which would be positive for stocks.
Okay, so tell me about these granny shots that you've got, part of your investing strategy, some specific stocks, especially since growthy stocks seem to be especially vulnerable on days like today. And if we're going to get more volatility, it sounds like we might get more days like today.
Yeah, that's possible. But investors really want to own stocks that actually have structural advantages. And that's best evidenced by revenue growth, margin expansion, earnings growth, and reasonable prices. So the reason growth stocks will still outperform is that in a period like this, if we have macro uncertainty, they're going to be names with some visibility. It's not pleasant to own a growth stock today, but we know the lesson of 2025 is that these pullbacks have not been deep and investors have been buying these dips. So I don't think today is any different. In fact, it's no different than the DeepSeek panic or the tariff day panic or the CPI panic. So, I think this is going to be a buying opportunity.
So Tom Lee, appreciate his thoughts there. But let me be very clear about Tom Lee, especially for the people that are newer to the market. Okay, Tom Lee very loved right now. People love Tom Lee. They're going to hate him. They're going to be talking so much. They're going to be talking so much trash about Tom Lee in the next bear market. Oh my gosh. People love Tom Lee right now. But I'm just telling you, people are going to turn on him so quick in the next bear market. You know how I know that? Because I watched what happened in 2022. So prior to 2022, Tom Lee was loved. 2021, Tom Lee was awesome. 2022 comes along, bear market, stocks are getting smashed day in and day out, and everybody's just talking so much crap about Tom Lee. He's a clown pumper. He doesn't know what he's talking about. He has no clue. He's paid to pump, blah, blah, blah. And so I'm just here to tell you guys, just wait. Next bear market, whether that's this year, next year, the year after, whenever, people are going to turn on him. They're going to be talking so much trash. The comment sections are going to be filled with just people dogging on him, making fun of him, saying he's clueless, saying he doesn't know anything. Just, I know how the game goes, man. Been on here a long time.
How would you like access to all my best course curriculums? My Becoming Master of the Stock Market course, my Stock Market Investing Mastery course, my Stock Options Mastery course, my Millionaire Playbook. How would you like access to all my best courses, as well as the ability to have access to my 6 and 7 figure plus Discord community, where we're constantly keeping in touch with each other, talking about what's going on in the market? How would you like exclusive weekly videos from me? How would you like the ability to see what stocks I'm buying and selling in my $2 million plus Fidelity account? If that all sounds pretty interesting to you, apply to join my private group. That is going to be linked in the description area down there. You can click on that, fill out an application, and go ahead, hop on a call with Andre. Andre will walk you through the whole process. He'll walk you through the whole group, and you can go ahead and join us in there. Once again, the link for that is in the description area.
This is very important. I start right here. What I'm showing you is a list of the biggest market cap stocks in the stock market. Now, the reason I want to start there is you got to understand the biggest weights in the S&P 500 and the Qs are by far and away the biggest market cap stocks. So there could be a lot of weakness in, let's say, smaller companies, and it won't actually affect the indexes very much at all. There could be a lot of strength in the smaller companies, and it won't affect the indexes much. The indexes are really going to be felt based upon if Apple, Nvidia, Microsoft, Amazon, Google, McDougal, Saudi Aramco, Meta, Berkshire Hathaway, Tesla, if those stocks are moving up, the whole market's going up. If those stocks are all moving down, the whole market's going down. So this is why I want to start here and talk about these companies at the top and if they're set up for a crash or if they're set up for good times ahead, because these ones will dictate if the stock market is going to go into a full-blown crash or if we're going to actually have fun times. This is much more important than what the Federal Reserve is going to do. It's much more important than what Trump and Elon are going to do. Any of that stuff. This is what matters the most, okay? So you got to look at valuation. You got to look at expected growth rates for these sorts of companies, right? So if we start at Apple, Apple's the biggest company. It matters the most to the stock market. It's the most important. So Apple trades at a forward P of, let's call it low 30s, 32, right? Maybe they come in and beat numbers throughout the year, so maybe it's a 30 or a 31. But let's say it's a 32 forward P based upon analyst estimates, right? Revenue growth for Apple should be in the 7%-ish range for this year. So I would call Apple a little rich, but it's not like it's some ridiculous valuation like Apple set up for some epic crash and load up on put options on Apple. It's not really set up. And they got a very stable business model. So investors are always going to will be willing to pay a premium for Apple because their services revenue nowadays. It's consistent. The money just pours in and pours in. They're basically like a government in terms of they just get this tax on the entire app store, and any popular apps on there, they just tax them, man. They get that 30%. So if some big AI app becomes super popular and everybody's downloading it over the next, year, guess who's going to make a fortune off that? It's going to be Apple. They're going to be taking their 30% tax, right? So Apple, a little rich, but it's nothing crazy, okay? Nvidia looks fine here. Forward P of 32 on Nvidia, right? With revenue growth of 50% plus expected over the next year. Now, keep in mind that you can make a strong argument that Nvidia is actually looking very undervalued here, but I wouldn't go that far to say Nvidia is super undervalued just because growth rates should drop significantly in 2026. I expect Nvidia probably to grow more in the 5 to 15% revenue range in 2026. So that's why I wouldn't say NVIDIA is a screaming buy. Like if NVIDIA kept growing revenue at 50% a year for the next several years, like NVIDIA is a steal deal here and you're going to make a fortune on this stock. I don't see it being realistic. I see 2025 being another great revenue year, and I think we're going to start to see a major slowing of buying these chips in 2026. And so I would say NVIDIA is fine here based upon the valuation. If NVIDIA was trading at a 60 or 70 forward P, I'd worry about it because I'd be like, okay, yeah, growth rates are going to be great in 25, but probably not in 26 or 27. We're fine here with NVIDIA. Microsoft, 28 forward P, revenue growth expected around 14% next year. Microsoft's fine. Like Microsoft's fine. Microsoft's not set up for some massive crash. Their business model just recurs and recurs. They have their cloud revenue. They have their obviously Teams revenue. Like it's just consistent, man. And so Microsoft looks good. If anything, Microsoft might actually look a little undervalued here. Microsoft actually might look good here. Okay. Now, when it comes to Amazon and Google, Amazon looks fine here. Forward P of 33. That's very low forward P based upon, this is one of the lowest forward Ps, if not the lowest forward P you've ever seen on Amazon in the company's entire history. This is extremely low for Amazon. And the company is going to likely grow double digits for years and years to go in the future, outside of some colossal recession. But even that, like e-commerce just continues to get more popular. Their advertising platform continues to get more popular. Additionally, their Amazon Web Services, and there goes an Amazon Prime truck, literally just passed by the window right in front of my house right now. This is perfect timing in regards to that. Like Amazon set up fine. So Amazon looks fine, if not good here. Google trades at a forward P under 20. The growth rates for Google should be, let's call it mid double digits, so probably anywhere between 13 and 15% for Google this year. They look good. Saudi Aramco, that one's kind of crazy because a lot of it's going to depend upon what oil price does over the next year. So, that one's kind of all over the place, but I think they're probably fine. Meta looks good here. 25 forward P. The company comes in and beats numbers quarter after quarter after quarter. So that forward P is probably in reality much lower than what it says here. Okay. Don't be surprised if the forward P on Meta is actually 22 or 23 or something like that. So even at a 25 forward P with revenue growth of 17% expected for this next year, looks good, man. Looks really good. Berkshire Hathaway, around a 24 to 25 forward P with 4% revenue growth. You say, well, maybe that's a little high. No, because what did I show you guys before? They're loaded to the sky with cash and short-term investments. So you're going to pay a little bit of a premium for Berkshire Hathaway, not just because of the stability of the great business models, right? But because of that massive cash hoard. And if we do have any market dynamic where the market goes down in a significant way over the next 6, 12, 18 months, Berkshire is loaded to just buy everything in sight. So I think Berkshire looks really good here. Like if you told me I had to go buy $100,000 worth of Berkshire stock tomorrow, I wouldn't mind it. Like, it's not like I want to do it, but at the same time, would I mind? Not at all. Like, I think I'd be just fine over the next 5 years buying $100,000 worth of Berkshire. Bottom line is 5 years from now, that $100,000 would probably be worth $150,000 or $200,000, right? Tesla, high, no doubt, forward P 119. Next year, revenue growth, we'll see probably in the 10 to 20% range. So no doubt Tesla trades high, but it's Tesla. Tesla always trades high, right? So the moral of the story in regards to these stocks is there's nothing to go off of valuation-wise here that makes you say, oh my gosh, we're destined for some big crash. These valuations are ridiculous. When you look at the growth rates of these companies and you look at the PEs and the forward PEs, nope, it's fair. Like they're fair, if not many of them are actually undervalued here and are actually a buy. Like if you buy Meta stock today, Google stock today, Berkshire Hathaway stock today, Amazon stock today, right? Like I think a lot of you're going to look very good. Even Microsoft, I think, if we fast forward even a few years from now, I think you're going to have made a lot of money on many of those stocks. Even if we fast forward 12, 24 months, I wouldn't be surprised. So do keep that in mind, okay? Now, the other beautiful thing we have here is not just a game of forward Ps versus growth rates. Also in, how a business model is valued over time, it's also about expectations, okay? So stock market plays a big game of expectations. Can you come in and beat numbers throughout the year, right? You come in and beat numbers throughout the year, people feel good. There's a good sentiment in the market. There's a good sentiment around stocks. You come in and miss numbers, you do poorly. You miss your revenue expectations, your EPS expectations, your margin expectations, your stock gets hammered. That's what happens, right? I've been watching all the big tech companies have reported now, other than NVIDIA, and they'll be reporting shortly. They've all set it up where there's not a lot of expectations for any of these companies, just to be quite frank. There's low expectations. Either the companies have guided pretty modest revenue growth, or analysts are just kind of like in a state where they're not expecting a ton from these companies. And so we're not going in with some sky high expectations for 2025 where it's like, everybody's expecting 30% revenue growth from these companies, and then they come in with 10 or 15%, and everybody's like, what happened? No, we don't have that situation. And so the setup is very good for this year. If these companies all would have came in with massive expectations and they all had crazy guides for big, huge growth rates, I would be worried, because then I'd be like, geez, if the economy weakens this year or something like that, like these companies are going to have trouble hitting numbers, and then that could get into a whole bad dynamic. Low expectations are set for these companies, right? So that right off the bat is one of many reasons why I'm not actually scared in this market, right? Next up here, we had a very bad year in 2022. Anybody that was in the market in 2022, you remember, right? Tremendous year to be buying stocks, especially in the back half of 2022. You were getting steal deals all over the place. But if you were in the market, you got likely smacked, right? In 2022. I got smacked in 2022. Everybody got smacked in 2022. It was invested, especially if you're invested in any growth stocks, right? With that being said, why did we have 2022, right? Keep this in mind. Going into 2022, we were coming off 3 banger years for the S&P 500 and the NASDAQ, right? This is S&P 500, a 29% return, 16% return, and a 27% return, right? And then we got smacked in 2022, right? So first off, we don't have a 3-year banger setup. We have a 2-year banger setup, right? Now, additionally, keep this in mind. In 2023, right, a lot of those gains were just get back. Like that was just getting back what we lost in 2022 because we came off of a really rough year. So 2023, although it looks like, wow, what a banger year, up 24%. Yeah, we were down 19+% the previous year. So a lot of that was just get back. So the real gain between 22 and 23 is only a few percentage points, right? Now, 2024, banger year for the market, right? S&P 500 up 23%. And then 2025, we don't know what the situation is. But the fact is, we didn't come off 3 banger years yet, right? Additionally, remember, we came off very high valuations. The big tech companies were all looking very richly valued in that fourth quarter of 2021. They're all trading at very high price to sales ratios, forward Ps, and those sorts of things. And what ended up happening was they had ridiculous comps, because we know what happened in 2021, right? World starts to open back up, but then you just had this massive stimulus that was out there. These companies started posting phenomenal growth rates in 2021. Well, yeah, all these companies post great growth rates, and what happens in next year? You have to comp against those numbers. And by the time you got to the back half of 2022, these companies were comping against ridiculous comps that were brutal to try to comp against. And so you know what happened? They started to miss numbers. They started to miss expectations. They had to start bringing down numbers, bringing down guidance, and it was a whole ugly situation. And the numbers were pretty brutal for many of those companies in the back half of 2022 through the first half of 2023. And so that's why that ended up happening. We don't have that same setup right now. We don't have sky-high valuations for those stocks based upon looking at the forward Ps versus growth rates. We don't have crazy expectations for these companies, right? And we don't have some ridiculous comps. The only company that has ridiculous comps they're going to have to comp against, really, is one company. Who is that? NVIDIA. NVIDIA is the one company that, if you want to look at big tech, their growth rates have just been ridiculous. And that's going to be a problem for NVIDIA eventually. When all of a sudden they say, we're probably only going to grow revenue 5-10% for a year, it's going to be an issue when people are used to 50 and 100% and 200% growth rates, right? But the rest of the stocks, you haven't had that. So that's another reason why I'm not very scared in this market. The next reason why I'm not scared is this right here. If we look at the public count, right, and we look at the stocks I'm positioned in, it's a lot of very strong companies. You start at the top, Meta, extremely strong company with a valuation that makes a lot of sense. And so am I worried that Meta is going to crash 50% and go down to $300 something? No. That would be the biggest gift in the history of gifts for any investors that are looking to buy if that happened and Meta goes down to 350. But that'd be the biggest buying opportunity in Meta since it went down under $100 in 2022. But don't hold your breath on Meta going down to $300 something. So Meta's looking really good, right? Tesla's very weak as far as the business model right now, but they still set up very well in the auto industry. They got the strongest balance sheet, arguably, of any automaker. And their income statement is still very respectable in terms of their total revenues. If you look at their profitability from many various things, and you think about the long-term trajectory of the wave they're in front of, I mean, it looks pretty strong from that perspective, but the short term looks weak. No debating that, right? Amazon's super strong like Donkey Kong. We know what it is. PayPal's super strong like Donkey Kong. AMD, I know it's a hated stock, but the business is extremely strong. And the way Lisa Su has positioned this company for the next several years is very strong. The company is set up in a very good situation. Palantir, very strong company position, very strong product portfolio, right? And very strong income statement and balance sheet. But with that being said, the valuations, even after this crash we've had recently, where the stock has fallen, 26%, 30%, whatever, in a matter of a very short amount of time, is still very high valuation, like sky high valuation even still. So Palantir is strong and weak at the same time. Nike's numbers have been very weak recently, but the company's setting up very well for the long term here. The company's looking really strong, and the stock has continued to see momentum. We're almost positive now on Nike, right? And that was one we were extremely negative on not even that long ago. Right now, we're almost to gains on Nike. That's incredible. Cheesecake, strong like Donkey Kong. Their numbers are extraordinary. Like, even if the economy was slowing or something like that, you don't see it in Cheesecake numbers. I mean, they were talking on the conference call about 11% up comps for Flower Child on a year-over-year basis. Come on, man. You got to be flipping my flapjacks. Things look good at Cake, right? Celsius, numbers have been weak recently, but they're setting up very well for the second half of 2025 and then into 2026, especially with the new acquisition they had. Celsius is going to likely start reporting phenomenal growth year over year, probably starting as early as the second quarter of this year. The second quarter, I'm expecting to start to see the growth, and then third quarter, fourth quarter, it's going to be a rocket ship ride. EL, blue skies ahead for that one. Obviously, EL's been very weak, but I think people are understanding like there's a great opportunity in EL over time. So blue skies ahead. Revolve looks strong. Fubo, blue skies ahead in regards to that, especially as soon as that Disney deal gets done. Don't be surprised if that stock goes from $4 to $8, like that, especially as you get closer and closer to the Disney deal actually going through. I think you'll see more and more momentum coming to Fubo. Elf's extremely strong. We know that, right? Stock's very weak, but in terms of the business model, strong as Donkey Kong. SoFi's very strong. Look at the numbers. Monster is very strong all the time. They're just a beast. They're kind of like a modern day Coca-Cola with a little better growth rates. Planet's very weak. We know that, but it's a speculative position. It hardly matters to the portfolio. $35K out of a $3 million plus portfolio is like a 1% weighting, right? And then Costco, making good money on these, but don't be surprised if I'm out of those, in a week or a few weeks or something like that. So this is another reason I'm not scared, because I'm just in a lot of very, very, very strong companies, and I'm diversified across. You see growth stocks in my portfolio, you see value, you see divs. If I was all in on growth stocks only and super high valuation, I'd be worried. I would be really concerned with my setup, but I've just done such a, in my opinion, great job. Not in my opinion, it's facts, actually. You look at the performance of the portfolio. Done such an amazing job positioning the portfolio for any market dynamic we get put into. Whether that means slow growth, high growth, low inflation, high inflation, whatever happens, like I own such great companies that they'll make it through the other side. They'll be fine. And their business models set up well regardless, right? Now, with that being said, I'm going to be very crystal clear about this. I'm not screaming bullish right now either, right? I'm not like, obviously this video is about why I'm not expecting a massive crash in the stock market, but I'm also not, you don't see me putting crazy money into the stock market right now. No. I'm still holding a good cash position. I'm buying stocks every week, right? And I'll make some deposits here and there that are kind of freak deposits, like, oh, let me throw $50K over here. But I'm not going all in this market either. Let me be very crystal clear about that.